Hey, welcome back. Ed Ponsi here, your FX educator here on behalf of FX Street once again. Good day, everybody. Good morning, good afternoon, good evening, wherever you happen to be. It's great to be here um, after a short absence. Right, I was in Boston last week. A little bit chilly up there, right? But it's good to be back. Good to be back with you and ready to discuss whatever it is you have on your mind. We're going to look at charts. We're going to look at fundamentals. We are going to look at economic indicators. We're going to look at whatever it is, risk management, technical indicators, whatever it is that you have on your mind. So do please let me know whatever it is you'd like to discuss. I've got the S&P futures up here on the daily, and they're just going ballistic. Almost 2,800 here on the S&P. Just an incredible performance here. A lot of green candles on the stock market, and the reason why I'm showing you this is because I want to juxtapose that with the U.S. dollar. And so stocks very, very green. Dollar very, very red, and you can see that line. That line was support, and we are below it. And the dollar, that's a pretty big break. Technically speaking, that's huge. We're at the lowest point, first of all, since 2014 on the US dollar index. So quite a ride we've had here. But what does it mean? Well, technically, it's saying that the chance of the dollar falling farther now has just increased a great deal. And we know that there are no sure things in this business. And because, traders live with uncertainty. That's what we do. We live with, the fact that we don't know. We know that we don't know, right? That's something that we have to become accustomed with, that we have to deal with, knowing that we don't know. And that's something that's just part of the deal. But I'll make this bigger. Right? No, that's not going to work. I'll make it a weekly. How's that? Because there are a lot of candles here. That's a huge topping area. And now you're under that line. That line was here. That was the lowest point. Prior to that, this was the lowest point. Right here. So we made a new low in September. And now we're making a new low, another new low, a lower low in January. So the dollar keeps making lower lows, and the trend is pretty obvious downtrend. So what's going on here? First of all, there really is not a lot of fear in the market. And the dollar is one of the currencies that tends to do well when there is fear in the market. The other is the yen. Now, the yen is doing well, oddly enough. But I believe the yen is doing well due to short covering. The market is massively short the Japanese yen. We know this from looking at COT data, commitment of traders data, right? And I apologize that you can't see what I'm looking at, but on a separate screen here, I'm pulling up the latest COT data for the yen, but the yen trade was massively one-sided. Now look at Canadian dollar. There's, the market's is leaning slightly long. You look at the Swiss franc, the market is leaning short. The pound, the market is leaning long, but the Japanese yen has 37,000 long contracts and 163,000 short contracts. So it's 4-to-1, 5-to-1, short to long. So let's pull up the yen. I don't think this has anything to do with fear. This move that you're seeing in the yen, I don't think it has anything to do with fear. In other words, the Japanese yen is doing very well on this chart. You're seeing USDJPY. USD is falling on this chart. JPY is getting stronger. And a lot of shorts. The market is leaning the opposite direction. The market is massively short the yen, and the yen is getting stronger. So the market is wrong. And when I say the market is wrong, I'm talking about large speculators, hedge funds, banks. According to the COT report, shorts outnumber longs by about 4-to-1, 5-to-1. Call it 4-to-1. Be a little conservative. The shorts greatly outnumber the longs, and they're on the wrong side right now. So what do you do when you're on the wrong side? You get out of the trade, right? And I think that's exactly what this chart is depicting. People on the wrong side getting out. That's what you're seeing, I think, on this chart. This is not fear. This is not you're not seeing people buying the yen out of fear. You're seeing people buying the yen because they're wrong. And very interesting comments. As the yen hits a 4-month high here, and we said the dollar just hit a multi-year low, the yen's hitting a 4-year high. And what's he saying? What's the Bank of Japan saying right now? The Bank of Japan is saying that the economy is improving and inflation is picking up. So this is a global phenomenon. It's happening everywhere. Could USD weakness pull dollar yen down? That's definitely part of it. You're seeing the euro and the pound are also at the highest they've been in a long time. So that's part of it, right? But it's not everything. Bank of Japan Governor Kuroda says inflation is around 1%. Now, 3 months ago, he said it was 0%. So suddenly inflation has gone from 0% to 1% in Japan. That's a big change. It's a big change, a big jump. And if you see a big increase in inflation like that, if that keeps up, Bank of Japan is not going to raise interest rates necessarily. No, let's not get carried away. Bank of Japan's not going to raise interest rates, but what could they do? They could stop doing all of this stimulus, bond buying, quantitative easing, which is still going on. Okay. Anyway, technically speaking, this is a major break. This is a big double top. So you see the reasons behind it are fundamental. But the chart is very technical. And the chart says this continues. Is JPY strong against other currencies? This is a very good question. In other words, let's look at relative strength. We'll get to that in a minute. Because they're all strong against the dollar right now. The dollar is very weak at this moment. There's your double top. And the way, generally speaking, that we measure this is, well, the way that we trade this is, first of all, we measure. And just from looking at it, you could say that the neckline is approximately 111. Okay, approximately 111. And 114 is the height of the pattern. So 114 down to 111, that's 300 pips. That would give you, generally, that would give you a target of 100, 200, 300 pips. Excuse me. That would give you a target down to 108. And guess what? 108 is also the area that we bounced out of earlier, right? That's down here. We bounced out of 108 earlier, so 108 kind of makes sense. But it's not that simple, right? Let's see how one might set this trade up. The way I would look at it is, this is a 300 pip. The height of this pattern equals 300. Right, from high to low, from 114 to 111. So everything is going to run off of that number. Everything runs off of 300. So 10% of 300 is 30. So here's how this could be used. The entry is 30 below 111. That's 110.70. So the entry is right there. We'll make that green. $110.70. That's the entry point. So really, you're at the entry point basically right now. The stop. That's 30 pips below support, which is now broken. That support should now act as resistance. And your stop is going to go above resistance. How far? Above resistance, 30 pips, because 30 pips is 10% of 300. So 30 pips above 111 is 111.30. So let's put a stop at 111.30. We'll make it red. $111.30. So I've got my entry at 110.70, which is approximately where we are now. And again, this is not a trading recommendation. I'm just showing you how people trade double tops, or a method for trading a double top. Okay. So we've got the entry, we've got the stop, and the idea is this. Right now, this might work, this might not work. I don't know, because nothing works all the time. If anything worked all the time, trading would be easy, right? Trading would be easy. Everybody would be a trader. Nobody wouldn't be a trader, right? And that's the resistance. That was support right here. Big bounce out of 111. So the idea is that if the price comes back up, it should hit 111 and stop rising. Why would it stop rising? It would stop rising because if anyone bought it here, not right at that moment in time, but at this moment in time, the thought process is this. Somebody looked at this chart and said, hey, 111 is good support. That black dotted line is good support. So when it comes back to that black dotted line, I'm going to buy it. And almost certainly somebody did that. It's not a bad strategy. It's just that it didn't work in this case. The fact is, it looks like it may have bounced, right? The candle goes up to here before it comes back down to that line. This candle hit that line. If you bought it there, you got back up to here. So maybe that does work for some people. On the other hand, if you're still holding it right now, you're losing money. If you bought it at 111 and you're still long dollar yen, you're losing right now. And the theory is that if it comes back up to 111, anybody who bought it at 111 is probably going to use that opportunity to get out of the trade because that is their break-even point. And human beings have a very strong tendency. When we're losing, we just want to break even. It is just normal behavior. Very predictable, normal behavior. Okay, so that's why that dotted line is so important to this trade. So we have our entry and we have our stop. We said 108 was actually a target. Well, 108 is a pretty obvious target. I'm going to go a little above the obvious target. How far above? How about 30 pips above? Because 30 pips is 10% of 300. Holy cow, the balcony collapsed at the Indonesia Stock Exchange. They're showing that on my screen over here. Never saw anything like that before. Hope everybody's okay. Target is 108.30. That's the Indonesia Stock Exchange. Balcony collapsed today, apparently. Okay, so that's my ultimate target. And so we hope everybody, all the traders and everybody over there is okay. All right. So we have an entry, we have a stop, and we have a target. But I'm going to use multiple targets on this. I mean, let's face it, that's a 60 pip stop. And that target is 250 pips. So this is 4-to-1 reward to risk. That's wonderful. But I would probably like to take something off the table if the trade is moving in my favor. One of the things I really like to do is take partial profit along the way. And one way to do that is with a simple 1-to-1. In other words, the risk is 60. What if the reward is also 60? 110.70 minus 60 is 110.10. Let's put a target at 110.10. And now I have two targets. I have a 1-to-1 and I have a 4-to-1. Okay. So I have Entry 110.70, stop 111.30. I have a target at 110.10. I like that because it's just above a large round number of 110 even. And we know that large round numbers, we know that they can sometimes act as resistance or support just by themselves, because orders do tend to accumulate on round numbers. It happens, gang. It just happens. Why does it happen? Believe it or not everybody who's in this business looks at charts. I'd like to point out that the majority of the activity in the Forex market is not created by people like you and me. The majority is created by people who simply need currencies to do business. So American companies that need Japanese yen, Japanese companies that need euros, European companies that need British pounds, British companies that need Swiss francs, and so on and so forth, right? That's the majority of what we're talking about here. Okay? So we could do the trade just like this, or I could add a third target if you're so inclined. Where would that third target be? Well, resistance is 111 even, and support is 108 even. You might remember when we began this process, we started the process by measuring 114 to 111, and we said that we create a target by then equaling that measure. So it's 300 from 114 to 111, take another 300 down, 111 down to 108. So 111 to 108 is the support and resistance. So what's halfway between those two numbers is the question. The number that's halfway between is 109.50. And if you use this type of template, try to get that right at 109.50, there it is. If you use this type of template, you're going to notice that your targets are very nicely spaced out, right? Because what do we not want to do here? We do not want our targets to sit right on top of each other. Okay, let me slide these over so you can see the numbers a little bit better. That way they're not mixed in with the candles. There you go. For the targets, there you go. Now we can see all the numbers. Okay. So 110.70 is the entry, 111.30 is the stop. And we just colorize everything from there. All the targets are blue. And it all makes sense. It all falls into place. Right. If I get down to 110.10, and certainly momentum is on my side, right? Price is moving in that direction. So if I get to 110.10, I'll bring the stop down to 110.70. If I continue to advance, and that way I can't lose, right? If I can get the stop down to 110.70, then I can't lose, because that means I've won a third of the trade and 2/3 of the trade become a break even. If we hit 109.50, I bring the stop down to 110.10. This means we've won 2/3 of the trade, and we will win the third portion of the trade, right? Because the worst case scenario becomes, well, the worst case scenario when you enter any trade is that your stop gets hit, correct? The worst case scenario, if we hit the first target, is 1/3 of the trade, we make 60 pips. And if I bring this stop down to break even, if I bring it down to my entry point, then the worst case scenario is 1/3 of the trade breaks even, and 2/3 of the trade breaks even. 1/3 of the trade makes 60 pips, so it's a small win. What if we make it to the second target? If we make it to the second target, I'm going to bring the stop down to here. So imagine this, on the way down, we closed 1/3 at the first target, making 60 pips. We closed 1/3 at the second target, making 120 pips. So we're 2/3 of the way out of the trade already. If it turns and goes back on us now, and we're stopped out, this is not a break-even stop at 110.10. That's a profitable stop at 110.10. We'll make another 60 pips if we're stopped out. You see, I don't need a miracle. If I manage my trade this way, I don't need a miracle in order to win. Some people set up their trade so they have one target way down here, and if that target isn't hit, they're going to lose. So they need a miracle to win. I don't believe in trading that way. I don't think you should set up your trades so that you need a miracle in order to win. Fair enough? Okay. And so this comes back to 111.30, and that's our little setup for dollar yen. Now the question came in earlier, is JPY strong against other currencies? It's a fair question because it gives you an idea about relative strength. Dollar yen, very weak. But what about euro yen? No, the euro is stronger than the yen, clearly. Pound yen. The pound is stronger than the yen in recent days. So this is not some big yen thing. It's more about the dollar than anything else, as correctly stated by Abdul. But I will tell you this, that the strength in the yen, it's not as if the euro has been crushing the yen. It's just right back to where it was earlier. And pound yen, same thing. It's just trying to get back to where it was. But the euro and the pound are very strong. We'll take a look at those during our next segment. I do want to remind folks that are listening that today is a holiday in the United States, so you might see light volume. Some U.S. markets are closed, some are open. But I would say it is a bank holiday. Banks are closed in the U.S., so expect light volume today. Okay, and also a very light economic calendar. No economic data out of the U.S. today, and frankly, not a lot of economic data out of any of the countries, the major countries, major economies today. So kind of quiet out there. Okay. All right. So anyway, so really the big story is dollar weakness, and we'll talk more about that in relation to how to trade it on the euro, the pound, we'll analyze that in our next session, which starts in about 30 minutes from now. So I hope you'll join us for that. Until then, this is Ed Ponsi, your FX educator on behalf of FX Street. I just want to say thank you for listening. I'll see you back here in about 30 minutes. Thank you so much for listening.